Hello and happy Saturday, August the 3rd, year of our Lord 2024. Man, where is the summer going? So just checking in with everybody, something a little bit different perhaps. I've been so used to doing radio programs and voice-only podcasts that video has not been something in my repertoire. Probably because I have a face for radio. So hey, any rate, I figured I'd do this because I could share with you some information and some screens that just give you some glimpses into we see and what we're seeing happening not just in the broad markets in terms of equities, but also what might be happening with regards to interest rates, what might be happening with regards to currencies, and what might be happening in the land of crypto. Bitcoin, I know there are a lot of people who are very interested in Bitcoin and what it's doing and what it's likely to do and all that good stuff that goes with it. So I do want to share my screens with you that will give you a glimpse into some of the tools that we use. Just a few, not to bore you, but just to give you a visual of how this stuff kind of plays out at least in our minds and in our perspective day by day. I've had a number of people ask me, what was it on Thursday and Friday that really caused some of the selling that we've seen? And of course the information on the tubes are all over the place. There are a lot of talking heads from you name it. My hope is that I'm not a talking head, but trying to give you some perspective on what's taking place. And a lot of the volatility that we've seen in the last couple of days is simply because dealers, Wall Street dealers, right, are in what we call negative gamma. And I don't want to go down the tube and needs of specifically helping you understand the nuances of gamma in the world of options. But just understand that when dealers are in a negative gamma situation, volatility has a high probability of being high or going up and down a lot, right? Volatility works in both directions. So in other words, volatility when they're in a negative gamma situation can provide a scenario where markets go down hard because volatility is up a lot, and markets can go up hard because volatility is up a lot. So it's a strange scenario that plays out in the realm of open markets for everybody to see every day. But when negative gamma, when short gamma is in play, then just expect some high volatility. But again, those situations can function in both directions. And so therefore we use algorithms to help us identify kind of the health of the flows that are happening inside market space. Flows from hedge funds, CTAs, dealers, all sorts of really big money players. And these algorithms are designed to try and help pick up whether or not the trend in the major markets is shifting. And so one of the tools that we use in terms of our algorithmic structure that uses both machine learning and fuzzy logic, and yes, I know you hear the term AI all over the place these days, but a component of advanced AI to help us, again, pick up the movement of flows in market space. And again, what we're trying to do is to make sure that we're staying in the flow of the trend, and that when the trend breaks, that we make an adjustment, that we make a shift. And sometimes that trend looks as if it's breaking, but it doesn't. And so it head fakes a bunch of people. In October of last year, in November, we saw this happen in April of this year. There are a whole host of instances that have taken place over a number of time frames where it looked as if the trend was broken, that something was wrong and it was going to shift. And the algorithms that we use helped to identify that the trend was not yet, in fact, broke. And so therefore, we're in a situation with high volatility simply because of short dealer gamma, negative gamma. Okay, fine. We're also in a situation where things are interesting in Japan. And you probably have heard this to some extent somewhere, that the Japanese government had, through their Federal Reserve, the Bank of Japan, if you will, has decided to raise interest rates in their market. Now that's interesting. Raising interest rates in the context of what we see happening on a global scale. In other words, there are things happening in global market space where markets are attempting to price in the effect of a recession. And in so doing, various central banks from across the world have decided to start cutting interest rates, and the expectation is that the Fed is going to cut interest rates at least 50 basis points at their September meeting, probably another 50 in November, and then one more in December. That's what markets are currently anticipating, certainly for September, and then November and December, of course, probabilities start to drop off. Well, Japan did the opposite. They raised interest rates. Well, when you raise interest rates, it tends to increase currency value. Why? Because you're going to get paid more by owning that currency when interest rates in that currency in that country have gone up. So what do you got? Well, for the past forever, I don't know, 25, 30 years, you've had a situation called a carry trade, where people are borrowing in yen because it's cheap. I mean, the yen has been one of these currencies that has continued a downward slide for a long time because Japanese monetary policy was all about monetization and keeping their interest rates low, and for the longest time, in fact, negative. That's great. You borrow money at zero, you throw it somewhere else, maybe making 1 or 2%. And because in most cases, the volatility spectrum on currencies is very, very low, you'll find big money institutions levering themselves up a lot. 10, 15, 20x, right? I mean, if you're getting a 2% bump by exchanging a trade from one currency to another and then levering it 10x, okay, well, that's not a bad return, presuming interest rates in the currency that you're borrowing stay low to negative, and presuming the volatility metric for that currency stays non-existent or very low. Well, that started to not happen when the Japanese decided they were going to start raising their interest rates. And so there are many who are suggesting that the carry trade, as it's called, is starting to unwind. Now, we have no idea the extent to which the carry trade exists on a global scale. All we know is it's a lot. Now, what's a lot mean? Trillions? Nobody knows, right? As far as I'm aware, there's not a metric anywhere that suggests an exact number of what that carry trade could mean. Yeah, I've seen all sorts of guesses and suggestions and things of that nature. Whatever, I get it. I'm not about to suggest that we just grab information from some internet resource that says, well, there's $22 trillion of carry trade that has been put in play over the past 20 or 30 years. Yeah, okay, whatever. Bottom line is that if, in fact, the carry trade is starting to unwind, then that would, by default, generate a fair amount of volatility as people unwind that carry trade. What's one element that we've seen, at least in just the last trading day, which would have been yesterday on Friday, August the 2nd, that suggests maybe that carry trade is, in fact, seeing a little bit of unwind? And the answer is gold sold off. Now, ordinarily, if the market was just attempting to price in a recession, you wouldn't see gold sell off. You'd see gold probably go up a fair amount. And it didn't. It actually sold off yesterday. And I'm going to show you some screens that help you to see and identify that gold is still very much in a bull market, that gold is approaching an area where we would want to take advantage of buying it if we could. And from that aspect, just get a glimpse into whether or not we are in the right spot with gold. But the fact that it sold off a little bit yesterday, in the midst of a down equity tape and in the midst of declining and dropping interest rates at a fairly large clip, across the interest rate curve, by the way, which again I'll show you, is something that suggests to us that maybe in fact an element of what we saw in global equity and interest rate markets was a function of that carry trade attempting to start to be slightly unwound. If in fact that's true, it's probably just the beginning. Now, that's not to suggest markets go straight down from here, but what we can say is that it is likely that deflation is probably something that we start to see a little bit more of. And if that's true, then a deflationary cycle is typically not great for equity markets across the board. And it doesn't matter which equity market. It could be the U.S. market, it could be an international market. And so therefore we want to pay attention to that. So with that said, I want to show you just a few elements of major equity markets here in the U.S. I'm going to show you Japan. I'm going to show you some interest rates across the curve to see how they're how they're acting and what our expectations are. And also show you the US dollar and gold. And then I'll end it with Bitcoin. So for just a couple of moments, this should help make some sense, or at least I hope. So let me flip screens for you here so you can get a glimpse into what I'm talking about. So this is a visual representation of what we use to identify rate of change of price, volume, and volatility on various timescales. And the ones that are most important is this white line here, which is a time scale of less than a month, and this red/green line that is representation of 3 months or more. So this is the one that you hear me talk about in my morning emails all the time as trade. This is the one that you hear me talk about in emails all the time as trend. Trend is a valuable piece of the puzzle because in most cases, if in fact we see trend be broken for at least 3 days or more, chances are that trend is in fact broke, and we enter into an environment of no longer buying the dip, but in fact selling the rip. And you heard me talk about that in February of 2022. One of the biggest made for the benefit of our clients was shifting from bullish to bearish in January, February of 2022, and in fact missing the majority of that bear market. Now, algorithms will help us identify whether or not the flows have dried up to the point of saying, okay, something real has manifested itself here in this market space and it's shifted, or is it a tactical buy, and are we now in a position where we should see markets shift higher? Good question. Our expectation is that we bounce. Now, why do I say that? Well, this is a volatility matrix right here, this little blue line. When this volatility matrix gets really high, it suggests that it's getting ready for a turnaround. And that's also true with what we call this overbought, oversold matrix. And it's not oversold yet. If it was oversold, you'd see this little big red bar show up right here. And this is what happened in April. You can see that in April, the S&P 500 broke its trend, 1, 2, 3, for 4 days. But on the 5th day, it popped back up. Now, ordinarily, 3 days or more is one where we suggest, okay, something's shifting, and we probably want to be careful and get out of the way. However, look at how high the volatility metrics was. Look at how low this oversold condition was. And then it gave us an oversold condition as it popped back above its trend line. That told us that institutions were likely buying and likely buyers. The fact that we have this volatility metric now above where we were in April suggests that the market has probably gone a little too far in its selling over the last few days. People ahead of themselves, a little too panicky, a little too freaked out. You know how that goes. And now they've experienced a perhaps change of heart. Now, is that to suggest we go up on Monday? No idea. Our algorithms are suggesting that we do see a bounce, a pop. Now, if that happens, I want to see it bounce, and I would love to see it get back above this trend level, which for the S&P is 54.55. If it got back above 54.55 and stayed there for longer than a hot second, I would suggest, okay, we're probably going to move higher here, and everything will be fine. This metric and this metric would not worry me unless it got down to this zero plane here and stayed there, and then this got up in this range and then gave me an overbought signal like what you're seeing here. Now, overbought and oversold can last for longer than people really understand. So we have to be careful of the fact that we have rising volatility within negative gamma, which means that volatility probably remains high both as markets come down and go up. And in the last 2 days, you've seen volatility high while markets dropped, whereas the day before, Wednesday, the 31st of July, markets were up a fair amount, 1.58% on the S&P, and volume was high too. Volume was high on Friday, which could suggest a bit of capitulation, a little giving up, a little quitting. And we think that that might be possible because the S&P 500 had what we called a put wall. A put wall simply means that that's where there's a lot of support at 5,300. People cash out their puts, and now dealers are forced to start buying, and when that happens, it tends to push the market a little bit higher. It hit on a low yesterday, Friday the 2nd, 53.02. Put walls at 5,300. So that was close enough to suggest that we maybe saw some of the puts get washed out, and if they got washed out, dealers probably had to start buying, and the fact that the market started to push higher a little bit gave us an indication that that may in fact have been what was starting to happen. The fact that this stayed high suggests that we're in that negative dealer gamma and it's just high volatility. I want to see this thing start to break down this way and then this start to move up, and if that happens, I think we come up and test this trend. If we hit trend and fail, it suggests that the market is still not done with its selling. If we break up through that level and then come to trade at 55.48 and fail one more time, that'd be the third failure inside of a month. That's the sort of stuff that says, okay, the regime is shifting, the macro environment is suggesting that there is a major change happening in the grand scope and the scale of what we're dealing with in global markets. So we'll see how that works. The NASDAQ has been below trend for longer, and this has got a lot of work to do to get back above its trend level. Whether it does or does not is going to have a lot to do on what the majors do. The Mag 7s, right? The Apple, here's a picture of Apple, stayed above its trend. That's good. Here's a picture of, picture of Amazon, which of course had huge volume on a big down day. I'm going to suggest people were probably buying Amazon. It's got a great big gap that it needs to fill here. And of course it would be a move back up to trend. If it fails that trend after a bounce, that too would be a huge signal on whether or not it was time or is time to just kind of play it safer and move to the sidelines. Google, same sort of picture as you can see. Tesla, closer to trend, however it came below it. But you see the one element that's the same is this high volatility and this low connected potential oversold scenario. That's a big deal, right? That's something that suggests a bounce is coming. Nvidia oversold. You know, we've got this scenario here. I do not like that trade has started to pass through trend. That is a bad signal that if it moves up to now the trade level of 120 for Nvidia and fails, Nvidia is probably going to go lower if it does that. And so we have to see whether or not that's what occurs. Microsoft, same story. So you can see, now we've got some buy signals that have kicked in on a few of these things, and we're just going to have to see whether or not that comes to fruition. Volatility, this is the VIX, which is volatility for the S&P 500, has shifted itself, and I've talked about this in our morning, into a bullish trend, and that is something that is different and new, as you can see, going back until we get to this April time frame. Starts to look a lot similar to what we had in April, doesn't it? Now, the fact that volatility got a lot higher yesterday just scared a lot of people, right? Volatility, VIX, hitting 30 is enough to cause people to just completely lose their minds and quit or sell. And this is where you need flow technology. This is where you need algorithmic technology to be able to identify whether or not people are just giving in, throwing in the towel, quitting at the institutional level, or if in fact institutions are starting to generate a tactical buy. We don't know. We'll see, but the flows suggest that there are reasons to believe that we bounce. Now again, if we bounce, that S&P 500 level that I showed you a moment ago is what's going to be important. Again, 54.55 and then 55.48. That's what we want to see. We want to see volatility for VIX break down below its top end trend of roughly 20. And then we want to see whether or not this trade and trend level starts to level off and then ultimately break down again. We'll see. If that happens, then VIX will start to shift, and we will get back into a more upward trending market. But for now, high and rising volatility is where we're at because dealer gamma is negative, and markets have shifted themselves for the short term slightly below that trend level, which again for the S&P is 54.55. We want to see it. If it bounces, I think we get a bounce back up into this 54.55 level. If we do sell off a little bit more in the S&P, on a longer time scale, 52.18 is really strong sort of support that you can see slightly shifted below in October of 23. This is where the bull market really got started. This would be an extremely short bull market if this is all of a sudden the end. Now, could we see 52.18 on the S&P? Yes, we could. Could it happen next week? Yes, it could. Could it happen next month? Yes, it could. Could it happen in October? Because October tends to be a weaker month than August and September combined. Yes, we could. So you can see there's a lot of scenarios at play, much of which will depend on what we see happening with volatility. Much of it will depend on what we see happening with interest rates. This is the 10-year Treasury yield, and you can see it has broken trend for some time. And I had talked about this in my morning emails a lot, but really not until this last week has it broken decisively. So clearly, we were talking about interest rates flirting with trend, failing at trade, flirting with trend, failing at trade, flirting with trend, failing at trade, and then finally a trend break, and this trade's getting ready to blow down through this trend level. That is something that suggests to us that interest rates are definitely now on a downward move. And interest rates on a downward move simply indicate a weakening economic environment, and a weakening economic environment brings about a deflationary cycle. Deflationary cycles are fine to some extent for bonds because it typically comes with hard and declining interest rates. Deflationary cycles are terrible for equities, so you have to be very, very careful there. So what do we expect for this? Same sort of thing. I anticipate yields to pop back up to trend, 4.13% for the U.S. 10-year Treasury on trend, 4.18% on trade. And I expect a failure there, just like what we've had over these previous three times. And that's enough to say, yep, interest rates have broken and shifted. And now we will see what comes next. The 2-year Treasury is a good proxy for Fed funds. It closed Friday at 3.89%. Fed funds are at 5.25%. So that can tell you interest rates should be in a situation where we see 1.25% to 1.5% interest rate reduction by the Fed sometime over the next 6 or so months. Now, if the Fed comes in and starts aggressively reducing interest rates prior to their September meeting, I think that would be a very bad sign. Markets would probably rally on that for a short term, but those who know how to handle that and know what's going on historically would consider that a fairly bad sign, because that's the Fed saying, oh crap, we screwed up, we're behind the 8 ball again, and now we got to catch up. And that is usually how it goes, sadly. Fed tends to go too far directions, and when that happens, they break something. I'm hoping it's different this time, but hope's not a strategy, so we'll continue to pay attention to the math in terms of rate of change of price, volume, and volatility on different time scales to show us how things are moving. This is a quick picture of put call. Typically when this pops high and this drops low, it indicates that markets have gotten ahead of themselves, and it suggests that markets are going to see a quick little bounce or turnaround. We'll see, but again, suggestions are just that, suggestions that's considering how the technical environment is playing out. U.S. dollar, interestingly, in a deflationary cycle, usually currencies at the U.S. dollar level do really well. And we can see that in a host of different ways. If I give you a different picture, here goes all the way back to 2022. Now, if you remember, 2022 was a very difficult year for most U.S. equities. It was an environment where we had deflationary risk off across the board.